If you like what you see, if I can please request you to subscribe to my channel. So what is mezzanine debt? The term mezzanine has been borrowed from the world of architecture. It refers to an intermediate story between two levels. Mezza means half or middle in Italian, so the word is quite a giveaway in that sense. Mezzanine debt is a hybrid type of financing that sits between equity and debt. It gives lenders the right to convert to equity in case of default. Mezzanine debt is senior to equity but subordinate to senior debt. Since the risk is higher, mezz debt offers more generous returns compared to corporate debt. This type of debt is used generally in established companies rather than early-stage companies. Mezzanine finance is thought to be a newer form of finance that has been around for the past 30 years, since the mid to late 1980s. So what are some of the common characteristics in mezz debt? Well, it has priority over preferred and common stock. It carries a higher return compared to senior debt. There generally is no amortization of loan principal, and these loans are largely unsecured. They could be structured with partially fixed or variable interest rates. So what are some of the pros and cons of mezz debt? The debt is long-term and does not dilute the owner's equity. It is certainly cheaper than raising equity. However, it is certainly more expensive than senior debt. It may impose restrictions on drawing down further debt and can also be very slow to arrange. So what's the final word? In a world of increase in banking restrictions, mezz debt offers flexibility and an alternative form of financing. It allows already established companies to grow even bigger. Generally, in mezz finance, you're dealing with companies having sustainable cash flows, proven management teams, strong market positioning, and well-developed business models. As that middle level, mezz debt has equity and debt tightly knit in its DNA. It can be customized to look more like senior debt or closer to equity, depending on what is needed by the transaction. So my question for the day is, what is a leveraged buyout?